continues in that direction. It's just a pullback. Whereas if we're looking at a major inducement of a reversal, right, it's before the mitigation. Okay, so we're coming up here. We have that algo candle. Our inducement's here, so it's a major inducement. We react from that, and then we go. Now, this realistically is just a zoomed out version of this for a sell example rather than a buy example, because we're always reacting to a pullback to create a major. Okay, I don't want to confuse you too much, but essentially we're always reacting from something in the higher time frame, so we always got to check it. Okay, but just to not confuse you, when we have a minor medium inducement pullback, it's after, but if we have a major here, it's obviously before the mitigation. Okay, because we run rather than pull back and continue. Okay, so where are we going to look for our algo candle? We're going to look for our algo candle after the pullback, because the main inducement's here, and we're going to look for our algo candle before the mitigation, if it's because it's a major inducement here. Okay, so what does an algo candle look like? So it's a sweep to the left to illustrate a manipulation formed at a certain time, because remember, we want to follow manipulation money. Alright, so we have a sweep to the left, sweep of liquidity. What sweeps liquidity? Manipulation sweep liquidity. And that creates our zone. We need an internal break of structure, so we have a supply level here and we break that supply level, and that illustrates an injection of orders from this point. Okay, and C, we need an unmitigated area, so this can either be an imbalance or like a wick OB. Okay, but it needs to show that the order block is unmitigated. We haven't tapped into the money yet. So here's just illustrating imbalance, internal break of structure, sweep of liquidity. Okay, OB forms, we have a major inducement, and then we run. Okay, here, a selling bearish example, right? This high sweeps, okay, breaks internal structure. This grabs that high, so this also sweeps to grab it, because when we have a mitigation, we need a sweep a form of liquidity. We leave this really nice wick, and then we push down. Okay, so if we're randomly here and this hasn't occurred yet, we have to wait for time and price. Once this hits the right time, we can see that this being a main inducement mitigate this, right? And then we have this big wick from the origin, and then we grab into that, and then we run down. Okay. So just an actual example, another actual example. All right. We have a sweep of liquidity, so we're sweeping inducement into another demand, and then we push up from it, break internal structure, and it's obviously unmitigated because of all that imbalance there. That mitigates that. Following manipulation money, we sweep into that zone, grab those orders, have an internal break of structure, which is also here. Have a bit of imbalance in here, which is detachment from this valid trading range. Main inducement, mitigated this to this, endpoint, reversal. Okay, this is right at the open, 30 minutes after the open, that wick formed. So obviously we know this manipulation is going to occur, but we got to look at what it's going to manipulate. Well, it's going to manipulate in here, and that mitigation cycle is finding that precision point and where it's going to reverse from, mitigating into that algo candle. Okay, and this obviously came from inducement pullback. Okay, so if this came from inducement pullback, we pulled back, corrected, swept internal liquidity. Obviously we had another inducement, and then we left off. Okay, and then our last step when we have these algo rules in place is our execution, and basically that's just utilizing the entry system to execute the trade. Okay, so realistically the entry system is based off multi-time frame execution. So if we're seeing these movements happen, we just got to see what time frame the order block is, and then we can utilize the entry system there. You can look at the last webinar for direct entry system examples. Okay, so this was from the last web, just this photo here, but we're just putting together the algo concepts. Okay, so what do we got here? We got an algo candle, alright, because we swept liquidity, broke internal structure, which acted as a supply level in the market, created imbalance, so we have unmitigated POI here. We created a main inducement. Now, the main inducement's the same as a mitigation cycle here because that's the lowest low before that algo candle here. Okay, and then time and price, right? So we have New York plus 30 minutes, right? We know there's a manipulation. We're looking at this low getting taken out as our main inducement for this point here, and we can execute directly from this POI. Get a buy. Entry at the top, stop loss at the bottom, execution to the next point of potential reversal inducement. Okay. Now we've gone through the main algorithmic concepts that are utilized. These are some other things that we should definitely be looking at, which also help to shape our algorithmic rules. So the first one's a high time frame influence. So high time frame influence will basically guide us to where price is moving from based on a reaction of sweeping liquidity. We swept these highs into a POI, so we're going to get a reaction to the downside. Okay, we got our premium and discount. So essentially, we should be using our 50% whenever price is within a high or a low. So if we have a low that forms and we have a high that forms, draw it out. Even if this was all on the 1 minute, okay, and we're looking for sells, this is on the daily, mind you, or the 4 hour, sorry. But if this was on the 1 minute, right, everything's fractal, so it can work on each time frame. Now, I was looking for sells. I wouldn't be selling until price was above this 50%. So it works for all time frames. But whenever price is within a high or a low, mark your 50% out. Okay. So just like it says here, connecting the fractal nature of the market. Premium discount, structural order flow. Okay. So just following order flow structure, we can see that we induced our valid trading range here, but we failed to create a new high from this. So basically that's our vector level, sweeping that inducement into our POI, but we failed to create a new high, and then failed to create continuational structure. Okay, so we're just following order flow from this point and understanding the traps that it creates. Asia types and the daily cycle. So this will shape exactly how our liquidity manipulations will work. Asia comes before London and New York, and it'll structure how those manipulations during the times we talked about just before will occur. Okay, so always mark your Asia type and the liquidity Asia's creating, or is it manipulating, and are we trading from Asia's manipulation? Either way, we got type 1, 2, 3. If you don't remember them, just review them in the other webinar. And of course, momentum. Intraday momentum and high time frame momentum. We're always having to meet intraday and high time frame momentum. So we can trade to the point where we meet that momentum, and then we can continue trading from whatever it brings. Okay. So just like here, we had a strong bullish momentum that formed to sweep into this supply. We come back to meet that bullish momentum that got created, and that created that big pullback up, but bearish momentum took over, so we trade alongside that bearish momentum. It's something that's not quantifiable, well, measurable. Really, it's not very measurable. It's more something that comes from the eye over time. So, but definitely mark it out. Okay, it'll help a lot just with the big arrow. Okay, some secret concepts. So when I say secret concepts, just reading up here, it means it's a byproduct of the algo rules rather than a direct instruction. So we were talking about direct instructions before, which are time, inducement slash manipulations, and mitigations of certain types of order blocks, like algo candles. But what we can do is we can trap our algorithmic rules to create different outcomes. So this one's called zone trapping. Um, and this one happens quite often, okay? Uh, so zone trapping is a sneaky trap that the market can do to invalidate the BFI algo instructions. So basically, the banks and financial institutions have an algorithm that basically runs the market, right? And essentially, this point of inducement, um, we sweep that inducement, but we do not mitigate the valid refinement, so the order block. So let's just read on quickly. What happens is we sweep a valid zone's inducement, but do not mitigate the valid trading range of the zone. What this does is create an inducement pullback rather than a reversal, and makes the zone a smart money trap by deactivating its inducement. Okay, so if you think about it, it mitigates imbalance. So we come down, we mitigate imbalance, we do not enter the zone, and it follows our rules of having a minor or medium inducement pullback. If you look at the entry system table, it'll tell you that after we sweep the inducement and we react to imbalance, we're going to have a pullback rather than a reversal. Now, when I say imbalance, I mean unranged imbalance, which means it's not imbalance within this valid range, it's imbalance above it. So it's not in our valid zone, it's imbalance above it. So it's not where the orders are actually located. Of course, if it hit the imbalance within there, it would be a different outcome, but it didn't. So we trapped the inducement for the zone by sweeping it and not mitigating that order block, and rather that creates a lesser reaction, inducement pullback, and then what we can do, we can trade sell continuations if we can see this happen to the end of the zone, because we know it's a smart money trap now. So if I see this, I'll call it on the Discord and I'll let you guys know when it happens, and how we can take advantage of selling from it, well, in this bullish example, rather than the people that are going to buy from here not understanding that a zone trap occurred. Okay. So next one's a valid trading range. So this is what I've been talking about with VTR. Okay. So a valid trading range is a maximum to minimum of what is actually valid in a zone for a mitigation. So a lot of people, and it's very fair, but a lot of people have trouble finding, what is actually valid with a zone. Okay. So we'll often see price induce the VTR. So this is a 4-hour example of a VTR, which is the body and the bottom wicks. Okay. Then tap into the refinement. So this is why we can mitigate areas that seem random sometimes, but rather they're part of a larger VTR that's visible on a higher time frame. So this is on the 4-hour. This is quite clear. We have the body and the wicks, okay, and we're inducing that VTR, valid trading range. Now a lot of people are going to say, okay, this is the order block, right? And they're not wrong. This is a valid this is a valid order block. It created that push to the upside, broke that structure, and we have imbalance there. But as you can see, we did not enter that because we induced the top of the valid trading range. Okay, so not always are we going to hit the refinement. Yeah, not always are we going to hit the refinement, but we're going to get into that valid trading range and have a nice reaction. So remember to look for the inducement rather than the order block. Okay. Just like I said, this is a 4-hour, this is a 1-hour. Obviously on the 1-hour it looks a lot more confusing. So that's where that high time frame comes into play and will help a lot. Just looking at this diagram here, we have an internal break. We have a valid trading range, which is that big movement here, VTR. then we have a refinement within that. Not always are we going to hit the refinement, but we're going to induce our valid trading range. And it finds the minimum and maximum of what's valid to mitigate. Okay. This is found on all time frames. Trick is to locate the inducement. What are we inducing? Pair that with time when we have those manipulations, and then we can understand how to trade from movements like this that are seemingly random. Because nothing is random. It might seem random, but nothing's random. Okay. If we draw premium and discount of this high low, that'll perfectly come into that 50% too, which will also validate our VTR. Okay. Okay, so this was sent in extra resources, but this is kind of why it happens. Okay. So we have an internal breaker structure. We create a low and a high, right? So what price is going to do, it's got to come into that 50% to continue to the upside, okay? This on the left being a pullback, obviously. Once we come into that 50%, what is created from our internal breaker structure is where our VTR will form, our valid trading range. We can trade from this area that broke that structure, come into that 50%, continue up, okay? So again, the structure gets broken, right? So this high and this low, obviously it'll look different. It won't always be exactly the high or low because we need the body and the bottom wick. But this high or low will create that VTR, the valid trading range. We'll induce above the 50%. Sometimes it'll be below, but we'll induce into that valid trading range, and then we'll move up. Again, high or low, right? And then a high forms, get that 50%, come back into that internal breaker structure, because under this break of structure is where those orders are injected to break that structure. It's going to come, fill up into that 50% to the valid trading range, and then move up. Okay. Then we create a new inducement on the other side to signify our shift in momentum. So this is what happens in internalized ranges. Okay. Until we create a certain shift. Yep, so just the same thing we've been talking about, the algo rules, but this is on a phase 2 entry. So we zoom into that 1 minute time frame. We looked at this last time, obviously, but just to have a look at what we're talking about, we have a new order block that forms. So we have an algo candle, manipulates, sweeps liquidity, creates imbalance, so it's unmitigated. We have a main inducement, right, which is our phase 2 that gets formed. Time and price, we follow time and price. So if we're here, for example, and this didn't happen yet, we've got to ask ourselves, what are we looking to induce? Well, because we had this algo candle form that follows our internal breaker structure rules, etc. And we have it's unmitigated, and we have this inducement forming as a retail trap. We know that we're going to manipulate this to mitigate this to create our movement. Okay, this comes up into that valid trading range, right, which is a body and the top wick. So if I were to draw that out, that will come right into that valid trading range, sweep the inducement, because like I said, it doesn't have to hit the refinement. Okay, comes into that valid trading range and then runs. So another entry opportunity from there as well. Okay, so just two more things which were posted in extra resources, and I just want to make sure you guys understand this one. Okay, but this is what we'll have if we have a minor. We'll have a shorter pullback. Okay, now medium, we have a more complex pullback to the downside but continue to the upside. But if this is a major, we'll just reverse entirely from there. So minor is a small pullback, medium's a larger pullback, and a major is a reversal. Okay, now where's the major inducement, which I said is important because after the main inducement we have our algo candle mitigation. Okay, this is our main inducement, yeah, because we're following that bullish order flow. This is for the minor. Now for the medium, where's our main inducement? It's here. Okay, So that's our major inducement, should I say, not major inducement. And then where's our major inducement for the reversal? It's here. Okay. And also something else that was in extra resources, just to explain. This goes directly into what we went through today, but here is just an example of following that BFI money towards a higher time frame POI until we have that shift in momentum. Okay, so these boxes illustrate accumulations. These illustrate manipulations. So essentially, we'll have build-ups before we have manipulation times. We find that main inducement, we track it back to the mitigation cycle. What's it mitigating? We need to see, and then we follow that. So again, we'll have a pullback. That pullback will create this movement back up to this manipulation area. Again, once time hits, so follow the time rules that were given on the second slide. But once time hits, we take a main inducement and we continue. How do we enter from these points? We just have to follow the entry system. Okay, so it's super mechanical. All right, but we've got to see what price is trying to tell us. Break structure again. All right, say this is Asia, for example. Main inducement, mitigated this, mitigation cycle, draw it out, find the algo candle, okay, which is just following the manipulation from the previous day, and then push. Also, if we're looking at the opposing side, what will be happening is we'll be trapping pricing to the downside here. This will either be a limit or a two-phase, depending on the time frame of this order block, and the inducement pullback strength. Okay. Once we hit into that higher time frame movement, we start creating more inducement, respecting the low rather than breaking it, for those reversals to happen. Once it happens, we mitigate that last point of supply, but it fails to create a new low because we create a new order block with inducement to signify our shift in momentum for buys. And then we align with that higher time frame momentum, because the intraday momentum's to the downside, the high time frame momentum's to the upside. At this point, we can see that we're aligning the higher time frame momentum with the intraday momentum, and then we can take advantage of selling those reversals. Okay, so that's it for today. It was a little bit shorter, maybe 15 minutes shorter than usual. But if you guys have any questions regarding this, please let me know. And I'll make some mini videos just going over it. Anything you don't understand about the lesson today. But from this, we'll make basically a set of instructions as if we're an algorithm ourselves, and we can apply this with backtesting. I'll make a backtesting video myself utilizing it, and you guys can copy how I do it, but it'll be essentially using what we did today. So basically time, main inducement that correlates with time, and what we're mitigating after that major inducement, which is mainly our algo candles, and then the extra information we went over today, just to ensure we're doing everything right, because the market will make everything look like it's so different all the time, but if we understand what's really happening, we understand the small rules that it implies, we'll be able to take advantage of it. All right.